Imagine you are a boss of a company and your company makes significant profit, let's say almost every quarter. Now, being a boss of a company, what would you think? Would you like to share your profit to your employees just because of them you could make the profit, or would you use that profit to grow your business more? Now, in the stock market, there are some companies, whenever they make profit, they use that profit to grow their business more. But at the same time, there are few companies, they like to reward their investors. They like to please their investors because of them they could make the profit, and in order to maintain the same investment by the investors, they reward them. You might have heard this word dividend. When a company share a profit made by them to their stakeholders, we call it as they issue a dividend. If you would like to know more about such dividend stocks, I believe this video is for you. And by the way, if you do not know me, my name is Mayur. I live in Canada, work as an engineer, and I make videos on personal finance. I'll be covering everything that you need to know about dividend stocks, like what is a dividend stock, how to calculate the dividend money, what happens to the stock price when a company issues dividends to the stakeholders, why companies issue dividends to the stakeholders, and let's say if you want to earn $500 as a dividend money in your bank account every month, how much amount of the investment you will be needing. So if you are interested in these questions, let's start it. Now let's try to deeply understand the actual meaning of dividend. As we said earlier, like dividend is a monetary benefit shared by a company whenever it makes a profit. Consider it as a kind of a thank you note. A company wants to say you thank you for investing and having a trust into that company's management, into the company's work, and just you invested your money, and when the company made the profit, company wants to share that profit with you in terms of the dividends. Whenever a company makes a profit, the board of directors must decide what to do with that excessive cash. Whether to use that cash to make the business more, or pay some debt if they have, or just share the profit with the stakeholders. Now, if you see this act of a company or profit sharing from an investor perspective, it is a kind of a passive income. Unlike the capital gain, where you can book your profit only by selling that investment feature, by getting the dividends, you are getting money too, but at the same time, you are holding that investment feature within your investment account. You do not need to sell anything. It's totally free money. If you see, most of the established companies issue the dividend on a very regular basis, mostly quarterly. There are some companies who issue dividend on an annual basis, but at the same time, there are few companies that gives dividends on a monthly basis too. But if you see in a general, there are mainly two kind of dividends that you can get. Firstly is the cash dividends that we already talk about when you get a monetary benefits. But some companies, they like to issue the stock dividends. They give you free stocks by just having the investment in that company. And if you want to book a profit, let's say a company gave stock dividend today, and after a couple of months, that stock price increased significantly, you can sell those additional stocks and you can book the profit too. Overall, you can say that when a company issues a dividend to the stakeholder, it shows that company is financially stable and it is completely healthy, because then and then the company is able to share the profit with its stakeholder without affecting its daily production or whatever the work the company is doing. But overall, when a company issues dividends, we can say that that company must be doing financially well, as well as it is very healthy in terms of its financial check sheets, because then and then it is possible to share the profit with the stakeholder. If company is not doing good, the board of director might be thinking to use that money into the business itself rather than rewarding it to the investors. So if you are getting money, consider that company must be good. I have been talking about dividend a lot, but I am a guy of number. I want to know how much amount of the money I will be getting in my bank account if I invest in a particular company that issues dividends. And for that, we need to learn two terminologies. First is the dividend yield. Second, total amount of the dividend issued by that company for the entire year. So mathematically, dividend yield is the ratio of amount of the dividends received by that company for the whole year divided by price of the stock of that company. Now, if you want to know the total amount of the dividend that you can get from a company, you will have to move the price of the stock from the denominator and multiply it with the numerator, that's the dividend yield. So the equation becomes amount of the dividend will be is equal to dividend yield multiplied with the price of the stock. Now let's understand this with a very simple example. Imagine a company which is trending at $100 today. That company issues dividend $5 at every quarter. That means for the whole year, company issued $20 as a dividend. Now, if we calculate dividend yield in this case, dividend yield will be is equal to total $20 in the numerator divided by $100, and the number comes around 0.20. And if we multiply this 0.2 with 100 percentages, we can tell that that company's dividend yield is 20 percentages for the whole year. But there is some little bit confusion for the new investors, especially who do not know about the dividend stocks. When you analyze a company, when you open any website for the stock analysis, you will not know how much amount of the dividend you will be getting from that company. You will not see that number onto that analysis page, but rather you will see the dividend yield number. So now you know, if you understand the relation between dividend yield and the stock price, you can assume how much amount of the dividend you will be getting by investing your money into that particular company. And this is how there are many smart investors who often look for a stable company who issues dividends and which are currently trending at a little bit lower price, so that whenever that company issues a dividend, they can have considerably good profit as compared to when their initial investment, because that company was trending at a lower price, but at the same time that company has been known to give good amount of the dividend yield. When I started learning about dividend stocks, there was one question in my mind very much often. Why would a company share its profit to the stakeholders? If I'm a company owner, I'm not sure whether I would share the profit with my employees, whether with my stakeholders, especially if it is a new company. And when I researched about this, I came to know that companies give dividends primarily to attract and retain the investors. And that's a big thing into the stock market. When an investor has been investing in a particular company, let's say from the 25 years, you can know the reliability of that company. You can know the profitability, you can know the stability of that company, and this will help the company to grow with a very steady pace. At the same time, it will attract more new investors. And when a lot of different investors try to invest into a particular company, that company does not need to do anything special to improve their stock price. And imagine, let's say you own a company, your company has been doing so much good and you are getting fund from n numbers of investors. I do not think that you need to do anything special to run your company profitably. Your stock price will get automatically higher because a lot of people want to invest in your company. And when this can be possible, only and only when you retain your investors, when you make your investors happy. And when you can make your investors happy, just by sharing the profit, by doing great in your business. Now, most of the companies in the stable industries like telecommunications, bankings, or utilities, they do not have a lot of chances of expansion. For an example, a particular bank has 500 branches, let's say in Canada. Now, making 500 to 1000 branches is not a feasible solution. Probably it is not requirement of having 1000 branches. So in this case, once this company paid all the necessary expenses, once they fund all the necessary projects, all the additional profit will be remained as an excessive cash, and these companies think that giving it to the stakeholder back is the most efficient way of using this profit. And that's the reason they issue dividends to the stakeholders. But what about the companies who does not believe in giving dividends? Are those companies not good? Are those companies not financially stable? I don't think so, not necessary. Now, growth-oriented companies, especially from the technological sector, for example, Amazon, such companies believe to invest all those profit 100% into the business itself, because these are the technological companies. They want to match with the technological trend, and we know that these days technology changes on a day-to-day basis. Such companies believe that they can bring better result to the stakeholders by, let's say, opening new tech centers, by acquiring other small companies, or funding into the research and development department, rather than handing out cash to their stakeholders. If a company can grow its stock price by 20% at the end of the year, I think it is more valuable to an investor's point of view, rather than getting 3% dividend value. And also, these new and small companies, they might not be profitable when it is in the younger stage. It is just started. So it is not possible to, share the profit with the stakeholders. And these are the reasons some companies do not prefer to share dividends in terms of the profit sharing. But here is the twist. We all know that in this era, nobody wants to help anybody. Nobody will give free money to anybody. Imagine I have $100 in my pocket. If I give $10 to somebody, how do you know whether it is going to affect my budget or not? In the same way, many people understand that dividend is a free money. But this is not true. In fact, when a company issues a dividend, it might be whatever amount, the value of that company immediately get decreased as soon as that money goes out of the door. And this happens on the day of ex-dividend date. On these days, you will see a significant drop into the stock price on the stock chart by the amount of the dividend that has given to the stakeholders. Let's try to understand this with a very simple example. Imagine there is a company whose total net worth is around, let's say, $100,000. Company wants to give dividends about $10,000 to the stakeholders. Now, on the ex-dividend date, if you observe, company's total worth will be reduced by the $10,000 because $10,000 has already been gone out from the company's balance sheet. Now, the latest company's net worth is about $90,000. That might go up in the future, but at this moment, once company issues the dividends, company's value would be reduced by the total amount that has been paid as in terms of the dividend. So mathematically, you need to understand that dividend is just come out from the stock price. It is not on top of that. When a company issues a dividend, you need to understand that you are just converting a portion of your investment, of your equity, into the cash. That's it. Now let's talk about the most interesting part of this video. Imagine that after understanding all this basic concept about the dividend stocks, you want to go for the dividend stocks. You want to have some of the dividend stocks in your portfolio. And let's say a fixed number, for example, you want to have $500 of fixed dividend income in your portfolio every month. That means $6,000 every year. In order to achieve this, what do you think? How much amount of the investment, capital investment, you will be requiring to invest into the stock market? Let me tell you that if you want to achieve $6,000 as a dividend, your investment must be in the range of $75,000 to $200,000. Now, do you want to invest this much of amount in a particular stocks? I don't think it is feasible, because imagine the company is giving dividend on a regular basis for a couple of years. But how about company is making loss? It is not sharing profit anymore. What I would do here is that rather than investing this much of amount on a particular company, and I have a risk of losing of my investment, it is possible, right? It is the stock market. I would invest in a ETF that involves a bunch of stocks that gives dividends on a regular basis, so that even if a particular company does not good in the near future, I can have still other companies doing better, and so that I can take overall benefit of all the companies that are giving dividends in the form of investing through the ETF. And these ETFs are called the dividend ETFs. If you Google it, you can search n numbers of dividend ETFs, and that will tell you the overall dividend yields that ETF has been generating. So if you define a particular ETF with particular set of the dividend yield, you will come to know the exact amount of the investment that you need to do in order to achieve $6,000 as an annual dividend. Now, so the total amount of the investment that you need to have will be the ratio of the total amount of the dividend that you need for the whole year divided by the dividend yield. If you know these numbers, you are set to know your total amount of the investment that you need for the investment. Now imagine you want to invest very precautiously. You do not want to put your money on a gamble. For that, you will have to invest in a very conservative ETF that has a dividend yield in the range of 3 or 4%. And if you invest in such ETF, total amount of the investment that you will be needing will be around $200,000. If you invest $200,000 in such ETFs, you will be getting $6,000 as an annual dividend for sure. And if you divide it by 12, you will be getting your $500 as a dividend value every month. If you are in your 30s and 40s and you can take little bit risk, I would recommend you to invest into some moderate ETFs, which is having a dividend yield of 5 and 6%. In these cases, you might be needing to invest around $120,000 to $30,000 so that it can give you the total dividend of $500 every month. And imagine you are very young, you have the courage to take the risk, you have a very long life to live, and you are very much set to take the risk. You can invest into the high risk ETFs that might have a dividend yield of around 8 to 9%. And for this, you just need to have an investment around $75,000 so that you can earn at least $6,000 as a dividend for the whole year. You can use this formula to decide how much amount of the investment you will be needing so that you can have desired number of the dividend, desired number of the fixed income, even if in your whatever stage of the investment you are. So in the end, I can just say that the companies who issue dividend to their stakeholders are basically good companies because they believe into the profit sharing. And it also shows the company's stability. So which companies are you buying this month for a dividend? Make sure you comment in the comment box. And with this, I'm signing off. I really believe that I could have helped you to enhance your financial knowledge at least by a bit, and I did that. I would really appreciate if you can subscribe to this channel. Until I see you next time, make sure you earn more money and keep investing. Thank you so much for watching.